My name is Marissa, and I'm a real estate agent at Century 21 Mission in Oceanside. Mortgage loans are divided into three categories: FHA, VA, and conventional loan financing. Let's start with FHA. FHA stands for the Federal Housing Administration. FHA has become the most popular loan type in the United States of America today. There's a lot of reasons for that. With only 3.5% down that they require and very flexible underwriting guidelines, it is far easier to qualify with an FHA loan than a conventional or VA loan. The FHA allows for cash at hand, gifts, and mattress money in certain circumstances, where other lenders or other loan types, would not allow for that. They're very flexible with their debt to income underwriting guidelines and ratios, and they generally are more forgiving in the case of blemishes on your credit or lower FICO scores. The FHA loan has a financed upfront mortgage insurance premium. That is the UFMIP. And what that does, it allows the lender who loans the money to be insured against their losses. Let me back up a little bit so I can explain. FHA insures the loan that you're taking out by allowing a bank like XYZ of America or Wells Fargo to loan the money risk-free. With that mortgage insurance premium that they collect, in the event of a foreclosure, FHA is able to pay the bank that lent the money for their losses. Before we go any further, let me put a little disclosure and disclaimer out there. This video is for information purposes only and cannot be relied upon for qualifying for an FHA, VA, or conventional loan. Every bank underwrites their guidelines accordingly, and although they have guidelines and guidebooks on how to underwrite, they use their complete discretion to make a decision on a case-by-case basis. That being said, the second type of loan that's available is the VA. This loan is for veterans only, active military or not. If you have served in the U.S. Armed Services and have a certificate of eligibility for a VA, you can apply. These loans offer flexibility in underwriting as well. And the best part about VA loans, you do not have a down payment requirement. These loans are guaranteed by the Department of Veterans Affairs. Much like an FHA, VA insures the lender against their loss. And VA does collect an insurance for this called a funding fee, which is also financed into your loan. In the event that a VA loan goes into foreclosure, which, by the way, we don't see very many because the VA is so active in helping their vets that they will do anything and everything to stop the process or to help in the middle of the process so the home does not get foreclosed. But in the event that it does get foreclosed, then this becomes property of the VA as well, and it's another government-owned home. VA loans are very much more flexible than conventional financing, just like FHA. Debt-to-income ratios can be pushed, and they do overlook a lot of other underwriting criteria that most conventional loans couldn't even think of doing. So this is a great loan as well. The third type of financing available is conventional financing, or the third type of loan, I should say. And these loans are the hardest to qualify for. They require a larger down payment, typically up to 20% down, and are much more restrictive in every which way. The source of the down payment must be established. The debt-to-income ratios must meet guidelines and are typically around 31% of your income can go towards your proposed housing, and about 36% of your income can go towards your housing and total debt. There's not much leeway there, and they're very, very tough on your bank statement deposits and withdrawals, and every part of your life is exposed much more on the conventional side because they do require much more documentation. So be prepared to have 3 or 4 months of your bank statements ready, 2 or 3 years of your tax returns together. You should be able to document everything that they ask you for, from small blemishes on your credit. If you forgot to pay your Macy's card in the year 1979, that might come up, and that type of thing. So they're very thorough. They're very hard to qualify for now, more than ever, because of the mortgage meltdown, understandably so. These loans are harder and harder to come by. The higher down payment, or the higher your down payment on conventional financing, the lower your mortgage insurance. But they do carry a very high mortgage insurance. Sometimes, it's $300 to $500 for this insurance, and it is not a mortgage write-off, or it's not a write-off on your taxes at the end of the year, not included in the mortgage interest or property taxes that you are allowed to write off. So this is not a benefit to you in any way. The mortgage insurance, again, covers the lender against loss. And on these loans, it's probably a lot more common, and you'll see loans repossessed by Fannie or Freddie because a lot of the loans that were made, even in the last 5 to 10 years, are Fannie or Freddie made, Fannie Mae or Freddie Mac backed. Candidates for these loans should have close to perfect credit, 680 or above FICO scores, with little to no blemishes. The down payment must be sourced and in a bank account. Unless it's 20% down, then a gift is allowed. Here are some examples of different types of loan programs that are used with FHA, VA, and conventional loan financing. 30-year fixed rate mortgages, interest-only mortgages, option arm mortgages, which really are a thing of the past and are pretty taboo, but they're still out there. Adjustable rate mortgages, and those come in every shape, color, and any way you want them. Adjustable mortgages are pretty much a thing of the past, and again, aren't very popular now, but they're still using them out there. The interest rates are starting at 2%, and I guess that really gets people enticed. Streamlined K mortgages, 203K mortgages, bridge or swing loans, and again, those were things of the past, but I've seen them come up recently. Home equity mortgages, and one that's becoming more and more popular in today's market is a reverse mortgage. Of course, the most popular right now is a 30-year fixed. Why wouldn't it be? I think that's the less risky, or the least risky. And being that the rates are hovering between 3.5% and 4%, it is a great time to finance. For more information, or for any questions you may have, please feel free to contact me by scanning the barcode or reaching me on Facebook, Twitter, or YouTube. Thanks so much for watching, and make it a great day.